We're going to walk you through the most effective method to merge multiple time frames for a more accurate and clearer chart analysis. By integrating price action with smart money concepts, we'll show you how to perform an efficient top-down analysis, overall market bias, key supply and demand areas, liquidity pools and zones of interest, and potential setups and trade opportunities from the higher time frames down to the finer details. So if that's something you're into, make sure to hit the like button to support us, and don't forget to subscribe if you're new. So, what is top-down analysis? Top-down analysis is a method that involves studying various time frames and broader market elements to develop a well-rounded view of overall market behavior. So, what exactly is top-down analysis? It's a method that blends multiple time frame analysis with various market factors to achieve a complete picture of overall market behavior. Beginning with the higher time frames and narrowing down to the finer levels helps us capture the broader market trend and highlight key zones across all stages. Just keep in mind, start from the monthly chart and apply each concept step by step. Doing that will clutter your chart by the time you get to your entry time frame, making it practically useless. In this video, you'll learn exactly what to focus on at each time frame to build a solid and informed analysis of any chart with ease. But before we dive in, let's talk about why is it important to analyze multiple time frames. Here are the top 3 reasons. Reason number 1, resolving directional confusion. Take a look at the GBP 5 United States dollars minute chart. The price action appears messy with no clear trend. It keeps breaking structure both upward and downward, leaving traders puzzled when trying to determine the market's direction. However, when we zoom out to the 1-hour time frame, the overall trend and bearish momentum become immediately clear. This zone is the same one we previously viewed on the 5-minute chart. By understanding the directional bias from the higher time frame, we can confidently look for short setups on the 5-minute chart. Always remember, if you're uncertain about the market direction, chances are you're analyzing the incorrect time frame. Looking at the broader view sharpens your ability to make more accurate and confident trade entries. Reason number 2, boosting accuracy. A small reaction from a higher time frame key zone can trigger a major trend reversal on the lower time frames. That's why, before executing any trade, it's essential to assess the distance to the nearest higher time frame supply or demand zone. This insight helps us plan our targets, set stop losses more effectively, and steer clear of unnecessary losses. Looking at the EUR 15 United States dollars minute chart, we can see a strong bullish push along with a distinct fair value gap between the wicks. This forms a valid order block, presenting a solid long entry opportunity. But then, the market abruptly shifts direction and completely disregards the demand order block, and if you're wondering why, here's the explanation. When we zoom out to the 1-hour chart, it becomes clear that this shift in direction might have occurred because price reached a key level on the higher time frame, one that previously acted as strong resistance multiple times. So, identifying these higher time frame key zones can help us steer clear of such avoidable risks. On the other hand, take a look at this example. On the 1-hour chart, we observe a move with clear inefficiency that breaks above the previous market structure. In this case, if the price successfully retraces to the order block zone, it would present an ideal chance to go long, placing our stop just beneath the swing low and aiming for the next visible market structure level ahead of the price. Now let's take a look at the higher time frame. On the 4-hour chart, we can see a recent breakout above these supply zones, indicating that demand is currently in control. There's also sufficient space for price to move before it hits the next unmitigated supply zone ahead. This setup could turn out to be an ideal trade, as it aligns higher time frame key zones and directional bias with a precise lower time frame entry strategy. Reason number 3, refining trade entries. Studying several time frames helps traders spot the most favorable entry and exit points. For example, let's say you're waiting for a pullback into the order flow zone to align your buy entries with the ongoing bullish momentum. If you place your buy orders at the start of the zone, your stop loss ends up being unnecessarily wide. So an optimal way to trade is to look for confirmation and open longs in lower time frames. This confirmation helps to get in the trades at a better price, reduces the likelihood of false signals, and increases the trader's confidence in their analysis. Now that we have discussed the importance of a multi-time frame analysis, now I'll walk you through the best technique to merge analysis across multiple time frames for a clear and well-informed chart analysis. But before we dive in, if you've enjoyed the video so far, please hit that like button to support us and drop any questions you have in the comments below. Now, let me guide you through our step-by-step higher to lower timeframe analysis, a process that starts from a higher time frame and progressively zooms into the finer details to pinpoint the best trading opportunities. In our chart analysis, we focus on three types of time frames. Starting with the higher time frames, weekly and daily, which we use solely to spot key levels in the market structure. Next, we work with the 4-hour and 1-hour charts for the bulk of our analysis, including determining overall market bias, key supply and demand areas, liquidity pools and zones of interest, and potential setups and trade opportunities. Finally, we use the 15-minute and 5-minute timeframes when we need additional confirmation and precise entry signals. Now, let's put these concepts into practice on real charts of multiple pairs to fully grasp this technique. Here, we're looking at the euro-dollar on the weekly time frame. In the first step, we mark the key market structure levels that price has recently responded to. To keep the analysis clean and effective, we only highlight the most recent levels near the current price. For instance, this level represents a historical high that has rejected price twice. There's also another key level ahead that has served as strong support multiple times. Additionally, we can mark one more significant level here. This is all we need from the weekly chart, the critical market structure levels that have a high probability of triggering a price reaction. Now, let's zoom into the daily time frame. On the daily time frame, we start by fine-tuning the weekly levels to ensure they align with the most touches from the daily view. Next, we mark the daily key levels of market structure using a different color. This helps us clearly distinguish between weekly and daily zones once we move into lower time frames. Remember, the higher the time frame, the more significant the level. That's all we need from the daily chart. However, there are three important guidelines to follow when plotting market structure levels. Step 1. Mark zones where price has interacted the most frequently. Step 2. Prioritize drawing from candle bodies rather than wicks. And Step 3. View these levels as dynamic zones, not fixed lines. Next, we rely on 5 conditions that define a strong market structure level. Each one adds more weight to the level's significance. Number 1. Turning points. These are zones where the market has previously reversed its trend. Such areas are perceived by the market as either overbought or undervalued, which increases the likelihood of price reacting to them once revisited. Number 2. Multiple rejections. When price is rejected from a specific zone several times, it indicates that traders consistently reacted at that level on different occasions, reinforcing its strength. While more rejections generally add credibility to the zone, they don't guarantee the level will hold. When price approaches a level, we closely monitor the price action to gauge market behavior. If each rejection becomes weaker than the last, it signals an increased probability of a breakout through that zone. However, if the price returns to this level afterward, it is likely to act as a strong support. Number 3. Dual roll level. When a market structure zone has served as both support and resistance in the past, it significantly increases the likelihood of price reacting to it again upon retest. Number 4. Strong departure. If price didn't just have a small reaction but instead made a sharp and decisive reversal from a zone, it highlights the strength of that level. The more significant the move away, the more critical that area becomes. Number 5. Fresh and respected zones. The most recent levels ahead of the current price action tend to carry more weight, as they are newly formed or recently respected, whether they are classic support and resistance areas or order blocks. Now that we've covered the key points, let's dive into the 4-hour time frame to advance our analysis. This is where smart money concepts start to play a critical role. At the 4-hour time frame, we now have both the weekly and daily levels clearly plotted on the chart. These levels serve as potential zones of significant support or resistance when approached by price. We utilize these levels in 2 key ways. First, a break either above or below helps us determine whether demand or supply currently dominates, suggesting potential continuation toward the next level. Second, we treat these zones as high time frame targets for our trades. The 4-hour time frame is also where we implement smart money concepts in full. This includes overall market bias, key supply and demand areas, recognizing order blocks, fair value gaps, liquidity pools and zones of interest, and potential setups and trade opportunities. In this scenario, the market has recently broken below a key daily level with strong momentum, signaling that supply is currently in control. We observe an inefficient move that created a fair value gap alongside a break of structure. The candle responsible for this inefficiency forms our order block zone, which may present a potential short entry. However, we cannot simply place sell limit orders on this zone, as the price has recently rejected a key daily level, suggesting a possible turning point in the short-term downtrend. Therefore, we must seek bearish confirmations in lower time frames, such as the 15-minute chart, before executing short positions. On the other hand, if the price breaks above both key levels, it signals strong bullish momentum, potentially driving the price higher to retest the weekly level once again. Now, let's zoom into the 1-hour time frame to continue our analysis. Once again, we'll fully apply smart money concepts, overall market bias, key supply and demand areas, order blocks, fair value gaps, liquidity pools and zones of interest, and potential setups and trade opportunities. Based on the higher time frame directional bias, we know that the market currently favors a bearish outlook. We expect the price to get rejected from the 4-hour order block after mitigating the daily zone. The market is currently in a deep retracement phase, creating liquidity zones on its way up. This acts as further confirmation. At the moment, price action shows a short-term uptrend. Ideally, we want to see a shift in direction where both the 4-hour and 1-hour time frames align in a bearish trend. So far, we've effectively applied price action and smart money concepts across the charts. The 4-hour order block remains a high-interest zone for potential trades. Remember, for a 4-hour order block, confirmation should come from the 15-minute chart, while for a 1-hour order block, we seek confirmation on the 5-minute chart. Now we're on the final stage of our analysis, the 15-minute chart. This is where we focus solely on confirmation and precise entries. First, we need the price to enter the order block zone and form a clear change of character. This signals the end of the short-term uptrend and confirms a potential shift toward bearish momentum. Without that change of character, there's no valid trade. Our first target would be the nearby daily level. If the market breaks below that, the next weekly level becomes our extended target. Before applying any setup to your live account, it's crucial to backtest it across various currency pairs to assess its effectiveness using past market data. Backtesting helps develop confidence, anticipate potential risks linked to the strategy, and enhance performance by adjusting specific rules and parameters. This process also allows you to fine-tune your rules for optimal execution. Now, let's move on and apply this multi-timeframe analysis technique to another currency pair to fully master the concept. Let's continue our analysis with the Aussie dollar. On the weekly time frame, these are the only key levels currently visible near the market price, so we'll go ahead and mark them on the chart. Now let's move on to the daily time frame. Here, we start by refining the weekly levels to align with the highest number of touches from the daily perspective. Then, we identify and mark any additional daily key levels that are clearly significant. Now let's jump into the 4-hour time frame. The market currently shows a bearish bias after reacting to the daily level, followed by a deep retracement into the order block zone. At this point, we have two possible scenarios. Bearish scenario: if lower time frame price action confirms bearish signals within the order block zone, we can consider short positions. In this case, our primary target would be the nearby daily level, and the secondary target would be the weekly level below. Bullish scenario: however, if the market breaks and closes above the order block, our 4-hour directional bias will shift to bullish. This would suggest potential continuation towards the daily and weekly levels above the current price. Now let's zoom into the 1-hour time frame to dive deeper into the details. On the 1-hour chart, we can clearly observe several price action signals. After the market mitigated the 4-hour order block zone, a change of character occurred, indicating that the short-term uptrend has ended and the market may now continue moving downward. This sets up a high probability short opportunity at the current 1-hour order block. Our first target would be the nearby daily level, and the long-term target could be the weekly level below. At this stage, there's no pressing need to look for confirmation in lower time frames unless you're aiming to identify additional trades. However, keep in mind that taking more trades doesn't guarantee higher profits. It's the quality and confluence that matter. If you found value in this breakdown, make sure to smash that like button to show your support and subscribe if you're new to the channel. Got any thoughts or questions? Drop them in the comments. We do our best to respond to every single one. See you in the next episode. Hand waving downward trend, upward trend.